Hello, everybody. My name is Karin Kisling. I'm Chief Investment Officer of Savity. Savity is an online portfolio manager for people who really don't want to manage their investments on their own, and so they entrust us to do it for them according to the targets they set us. And we do this on a digital platform called Savity. We like to use ETFs, as you will see, and I will explain why we like it and how we use them. And I hope that there's something there for you as we go along. So I'll start with the basics. I hope that's okay, and then we'll work our way on. First of all, what is an ETF? It's an exchange-traded fund, and exchange-traded fund already gives us two important bits of information. ETFs are investment funds, and they are traded on the exchange. That is very unusual for an investment fund, because usually when you want to invest in an investment fund, you say how much money you want to invest, and then you wait until the end of the day. And when all the prices for all the stocks on the exchanges have settled, then the value of the investment fund is calculated. It's called the net asset value, the fair value of this fund. And then on the next day, you know at which price you actually bought your investment fund. Whereas if you invest in an exchange-traded fund, you can trade anytime during trading hours, during the day, at the prices as they come along. So it's much more flexible. It gives you much more liquidity, and you are in control of when you trade and at which price you trade. ETFs are index funds. So what they do is they're a very special kind of investment fund. What they do is they replicate a market index. We've already heard about a few of these indices. So an index is really a special segment of the market, of the capital market. That can be the stock market, that can be the bond market. And it's a rules-based concept of how you create a basket of securities that replicate this part of the capital market that you want to invest in. So very well-known indices, market indices are, for example, the DAX or the S&P 500. And an index fund simply replicates these indices. So that means it's a passive, we call that passive investing. You simply passively follow the index, and one-to-one, you replicate it, and as an investor, you get the performance of the market, therefore. There is one important rule which is typically used when an index fund, when a market index is created. It's called market capitalization. And the concept goes as follows. Market capitalization is simply the number of shares a company has outstanding times its market price, the price of the shares. That's the market capitalization. And the market capitalization concept, when we use it in a market index, simply says that a company that has a higher market capitalization than another one is weighted higher, and exactly in this relation, it is weighted higher than the other company, and that is market cap. These are concepts that are very important to keep in mind as we go through our presentation here. I've been asked, what kind of an ETF should I invest in? Well, first of all, you have to make up your mind which asset class you're interested in. Are you interested in the stock market? Are you interested in commodities, in bonds, in money market instruments, in currencies? Are you interested in sustainability? You can have all kinds of markets cut out that fit exactly to your requirements. For example, you could say, I want to invest in a tech stock market index that is sustainable. You can get that. There in the German-speaking area, we can invest in more than 1,400 ETFs, which are available in a regulated framework for us as retail investors to invest in. So it's a huge market. It's a huge universe where you can pick and choose. So how do you actually pick and choose? That's the second question then. How do we get an overview? What I would recommend is that you check it out in specialized databases, and be careful to choose an independent database. I rather like just ETF.com. That's a database that is managed out of Germany. It's really very good, very comprehensive, almost 1,500 ETFs on there. And you can work your way through this database by saying, okay, I want to have a stock market ETF. I want to have US as a region. I want to, so by asset class, by region, by characteristics, by cost, by size of the fund, anything you want to sort, you can sort by. So it's a very, very handy tool to find the ETF you might be interested in. One other important thing that you shouldn't overlook is taxes. As a retail investor, you're taxable in the country of your residence. So be careful that the ETF you want to invest in is what we call a white fund, is efficient in the tax regime where you are situated. For Austria, I noted the database that you should refer to. It's the ProfitWeb database from OKB, so Österreichische Kontrollbank. And if you're an Austrian tax resident, check that your fund is a Meldefonds in Austria. That is really important, so you're tax efficient. Now, if we stay with this just ETF database, and we say we've clicked on a certain fund, we wanted to invest in a global equity ETF, and we found iShares, MSCI, ACWI. The neat thing about ETFs is it's a very transparent, very structured market, and not burdened with a lot of imagination, shall I say. So very structured, and you find your way very quickly through this mass of ETFs. It works the following way. Usually, the name of the ETF starts with the fund management company. So this ETF was issued by iShares. iShares is the largest provider of ETFs globally. So it's a really big company with a huge load of ETFs that they've issued. The ETF we're looking at here is called iShares MSCI ACWI. ACWI is a global equity index, which was constructed by MSCI. MSCI is one of the leading index providers in the world. You may have heard of MSCI, of FTSE, of S&P. These are very well-known index providers who spend their time really constructing indices. And iShares has a license agreement with MSCI to use their index with all the rules that apply so that they are able to replicate it one-to-one. So that is iShares MSCI ACWI. And then the next bit states how this fund is regulated. And that is something with most of the funds on this database, you will be safe because these funds are all UCITS regulated funds. The UCITS concept is an EU-wide regulatory framework for investment funds, which also, of course, covers ETFs. And it's a very, very safe structure. It's a very well thought out structure, which really aims to safeguard the interest of investors. It is by now a global brand, so that is something where the EU did very good work in developing a regulatory framework. So you should feel good when you see a UCITS ETF. The next thing is ACC. Now that is an abbreviation for accumulating share classes. When you invest in stocks, usually companies will give you a part of their profits in the form of dividends. And when you invest in bonds, the issuers of bonds have to pay coupons. So part of profits are distributed to the investors. And of course, when you're an ETF investor, you have the right to these profits. And you can choose now, by the share class you choose, whether you actually want to have these distributions credited to your account, or whether you want to have them accumulating and automatically reinvested. That is what an accumulating share class is. If you want to have them distributed, then you choose the distributing share class. I would recommend using the accumulating share class because you have to reinvest yourself again and again and again. It's tiresome, it's inefficient, it's costly. Now, when we look at this little snapshot, we find that under on the left-hand side, under the name of this ETF, we see a number called ESIN. ESIN is a number which is unique to every single security in the world. So when you know this number, you can Google the asset in all kinds of ways, and you'll find lots of information on this one specific security. What are figures and facts that are worthwhile when you look at such pages? You will find figures and information on this website here. You may also want to click on the fact sheet. The fact sheet, that is what you see here. The fact sheet is something that is issued by the fund's issuer. So they will give you information on a monthly basis about how the fund is doing, what are the key facts of the fund, and then they are also obliged to provide you with the KID. That is a short resume of the prospectus of the fund. So that is a legal requirement by the UCITS regulation. And it gives you, in a very standardized format, lots of information about the fund. It makes it very transparent and comparable to all the other peers, that the fund can be compared against. One of the most important informations that you might want to look at is cost. That is, how much do you pay the fund management company for managing this fund, for doing the work for you as a passive investor. That is a charge where you will find two names, usually either total expense ratio, TER, or ongoing charges. It's both pretty much the same thing. Yeah, so it's the ongoing cost that is deducted from the profitability of this ETF. What is important is you don't pay for this extra in your account. It's already done on the fund basis, on the ETF. Yeah, so it's already deducted there. Usually you will look at performance figures, and you will find those performance figures in the material that I've just pointed you to. But let's be quite frank, what is the 1, 3, or 5 year performance that you look at? It will be the market performance. It will be the index performance, or pretty close to the index performance. Once we deduct the ongoing charges. Not a lot of added value when you look at that. Same with volatility. Volatility is a measure for risk, for the risk of your ETF, for any kind of security actually. What we measure is, in statistical terms, the standard deviation of the daily performances of this product. So how much fluctuations do I have to expect in the product? That's called volatility. It's an annualized figure. And down here you see the volatility. This is a pretty aggressive product. It has a volatility of 26%. So you will have fluctuations on an annualized basis of 26%. What I like to look at is fund size and issuance date. Why? Because a big fund that was issued quite a while ago is a very well established product. It's likely to be there for quite a while, and that is what you want to invest in after all. So you want to have a stable product that is there, that is liquid, that is well supported by the fund management company, and these two parameters point you in the direction that this is such a product. What might also be of interest is top positions. So you have a feeling what's actually going on in your portfolio. What is the MSCI ACWI all about? What kind of assets do I hold? And that's it. Now, why do we at Savity like ETFs? Well, and why should you like ETFs? Well, you can invest with very small amounts. You invest in shares of an investment fund, remember. And one share has a denomination that can be 10 euros and that can be 200 euros. That is already a very large denomination in the ETF space. When you think about Warren Buffett, you know, his Berkshire Hathaway, that's one share is worth several $100,000. So that is not for the average retail investor. But ETFs are made for retail investors, and they have very small denominations. So you can start with very small amounts. And when you go for a savings plan, you are even able to invest in decimals of one share. So it's really very neat. And what you get for your 50 euros or whatever you want to invest in is you get a whole market. You get your share of the S&P 500, of 500 companies as they are represented in the S&P 500, and you invest 50 euros for that. And you do get the market performance of the S&P. I think it's a pretty cool concept. Now, let's look at the cost in more detail. We were told initially that we should look at the total cost of 0.5% per annum. I think that's very ambitious. And I'm sorry, I have to tell you, I think you'll be paying more. Why? Because the cost of investing in capital markets is made up of several components. First of all, you have to have an account, and you have to pay your broker for executing your trades for you. That can be a broker or a bank, doesn't matter. It's pretty much the same. What I did is I compared funds and ETFs here. So you have an idea of the cost structure that you countenance when you go into this market. You can see that you are able from some online brokers to actually get a deposit fee. This is where you keep your securities, where they are held for you, at 0%. Yeah, so you don't pay anything for it. Banks tend to charge a little bit for it. But what is more important is the ticket fee. Every time you buy or sell an ETF, you will have to pay a ticket fee. And the ticket fee is very important because you have to pay a minimum fee. And if you just invest, say, 300 euros, and you have a ticket fee of 7.99 euros, that is already pretty hefty because that's more than 2% after all, in terms of fee in relation to your invested amount. So be very careful when you invest small amounts and when you trade frequently, because these fees add up. What you should also be careful about is you should not invest in ETFs that are not euro denominated. It's not necessary. You can find anything you want that is euro denominated. If you go into a dollar denominated product, that can be very costly. So try to find euro denominated products. Most dollar denominated products trade also in euro denomination. So you don't have to go through FX fees. They're very costly. Try not to have that. Next step is, once you have decided to go into the market, buy your fund. In investment funds, you're charged premiums over net asset value. And these premiums are very, very expensive, up to 5%. So you should really try to lower your cost there. The nice thing about ETFs is, while they may charge by their prospectus, by the regulator, they may charge those fees, they usually don't. You usually get them for free. So you don't pay any premium over the market price at which you trade. You just pay the ticket fee and that's it. And that's a rather cool thing because you really save a lot of money. And then last but not least, as I said, you're left with the running cost, with the charges that the fund management company charges for actually managing this portfolio. And as I mentioned, passive funds are much cheaper than active funds. Why? Because an active manager is very ambitious. He tries to outperform the market, whereas the ETF just, delivers the performance of the market. This ambition of active managers, I would warn about that because it's very hard to outperform the market long term. There have been lots of studies, and usually less than, for long term, less than 11% are able to outperform the market. So it's very hard to find managers like that. Now, another thing that I believe is rather attractive is that we ourselves can trade this market. I give you a snapshot here from an online broker. And what you see is that an online broker will usually offer you several options who you trade with. So you can, the first three options that we see here on this page are actually investment banks and brokers who trade in their own name. So you trade what we call OTC, over the counter. And the very last one is actually an exchange, that's Xetra. So here you trade over the exchange. And frankly, it's pretty much the same thing. The important thing is that here you see the prices they quote, the bid and the offer spread, and you can choose now who you want to trade with. The bid offer spread, called Geldbriefspanne in German, is really the difference of a price that the trader will quote for how he is prepared to buy and how he's prepared to sell. And you can see in this instance that this Nasdaq ETF is very, very liquid. They only charge 0.02%, so 2 ticks, bid offer spread. So it's a very liquid asset, and you hardly have any transaction cost. Whether it's the exchange, whether it's the OTC market, it's very liquid. But always keep transaction cost in mind. Next one is why we at Savity like ETFs. I think it's pretty clear now. What we like about it, it's very clean products. Market indices give us as portfolio managers a very clean profile from which we can optimize client portfolios. And that is how you see a typical portfolio would look when it's professionally managed.
Genau.
Das ist gut.
Yeah. Okay. This all looks wonderful. So I've told you now about the good stuff about ETFs, but there are also a few things that you have to keep in mind, that ETFs or index investing is not always the perfect solution. And there are some disadvantages to the concept, particularly of market capitalization. Because markets are not always efficient, and market capitalization works best for stock market products, not so much for bonds. If you think about it, market capitalization means the bigger you are, the bigger your weighting. That means for bonds, which is debt, the more debt you have outstanding, the higher your weighting in a bond index, and that is not a very healthy concept, I think. So that is a bit of a risky thing. And as you can see, markets which are inefficient, particularly bond markets, it is quite easy actually to generate outperformance with active products. So I gave you 2 examples here. One is emerging markets, which are by nature inefficient. One is a corporate bond portfolio. And you can see here, when you compare the actively managed stuff against the index, that active managers can substantially outperform the index concept, particularly on the bond side over time. Another thing that I would recommend looking at is a currency. When you invest in a S&P 500 ETF, the ETF is of course replicating a dollar index, so you carry dollar risk when you invest in an ETF. When you invest in an S&P 500 index, you can hedge that, and you have to make up your mind whether you hedge it or not. So keep that in mind when you go into international markets. Another thing that I think is worthwhile mentioning, because we've talked a lot about crisis today, is that one of the best things about ETFs is liquidity, and it's also one of, in a way, one of the problems that ETF can face in a crisis. Because what happens in a crisis is that you can have a stampede. The herd moves, and they all move in one direction. They want to get out. And that it leaves the traders who will quote the bid offer spreads that I mentioned, the prices that I mentioned, Now that leaves traders in a hard place. And what they do is they will not give you the fair value of the asset. So they will simply pull down the price, or they will increase the bid-offer spread. And what happened during the Corona crisis, which is what you can see here, is it happened both at the same time. Yeah, this is an ETF. So the ETF fluctuated by 8, almost 10%. By comparison, a mutual fund fluctuated by 4%, so much less. Yeah, so this is a bit of the risk which you have to keep in mind. So don't panic when there's a crisis. Keep your nerve, because if you trade during the crisis, chances are that you're really ripped off. Another last page here is the cost of ETFs when you have a small portfolio. We were asked, how small a portfolio should I have? As I said, you can start very, very small, but be careful not to trade around that portfolio, because that's a killer. What I show you here is an example of a savings plan, monthly savings plan of 100 euros and an initial deposit of 1,000 euros. And I'm very modest here. I just invest in 2 assets. So my 1,000 euros and the savings plan afterwards will only be invested in 2 assets. And I show you here, I made that anonymous. These are online brokers which are active in Austria, and they're very well regarded houses. And we tried to work out the cost from their term sheets. And as you can see, depends on which broker you take, costs can be substantial when you have a small amount and you have a savings plan, because savings plans also have transaction costs, unfortunately. And you start to rebalance. What we did here is we assumed that once per year you would rebalance your portfolio. And that, so at the end of the day, you invest in 1,600, and that is the fees that are charged. So be very careful when you trade around small portfolios with lots of sizes, with lots of different positions. That is not very healthy. Try to be very compact in your portfolio. And that's it from my side.
Well, thank you, Karin, for these great insights. And yes, there are some questions already. So first, maybe Jana, you got some answers already. Would love to hear more about good distributions within ETF savings plans. How do I get the balance right? Is it still worth having, say, 30% bonds in my portfolio? Maybe you can say a bit more about this, Karin.
Okay. Well, really, the mix of assets. So, how much you want to invest in bonds, and how much you want to invest in stocks. That very much depends on your own preferences and on your investment horizon. When we try to identify which portfolio fits a client, we have 3 criteria which are important to us in our talk or in the onboarding process, because we're a digital company, when we try to get to know our clients. The first is, for how long do you plan to invest? The longer you invest, the more equity stake you can take. The less you invest, the shorter your time span, the less you should invest in equities. As a general rule, always try to have an investment horizon that fits one business cycle. Why? Because within one business cycle, even if there's a crash like now, you will make it up. For example, when we went through the crisis of 2008, where markets lost more than 50% of the value, after 10 years, you would still, even if you went in exactly before the crisis, you would still have made about 10% per annum over the remaining 10 years, because you would have recovered everything. So being able to invest over a business cycle is crucial when you invest in equities. And then you can invest a substantial portion of your holdings, but you have to sleep well overnight. And if you feel that 50% drawdown or 40% drawdown like we had now with the Corona crisis is too much for you, then you start to add bonds. What we would recommend is coming up with a risk budget where you say, this is how much loss I can afford. And that will give you a very clear idea about the mix of stocks against bonds. So if you say, I cannot live with more than 15%, for example, or 10% loss, then you will come up with a portfolio that's about 50-50 or 40-60 stocks to bonds. That would be my recommendation.
Thank you. So maybe
listen to yourself.
So maybe Elisa's question would fit to this. How long is a business cycle? 10 years or what is?
Well, we had a very long business cycle during the last business cycle. So that lasted longer than 10 years. So we from 2009 to 2020. That was one of the longest business cycles ever observed. Usually business cycles take about 7 to 10 years, and that should be there for the horizon when you invest in equities.
Okay, yeah. How can I hedge the currency risk?
Actually, you don't have to do that yourself. It's very costly when you do it yourself. I would recommend investing in an euro hedged class. So I mentioned the S&P 500, right? And there are lots when you start to search for an ETF on the S&P 500, for example, you will find lots of ETFs. And then you say, okay, but I want to have a euro hedged ETF. And the euro hedged ETF will give you the hedge. So you only participate in the performance of the stock market index, but you are not affected by the FX risk. Yeah? So it's easy to get that. There are lots of products out there that will offer that to you. It's slightly more expensive. It costs you about 10 to 15, so 0.10, 0.1 to 0.15% more than a plain vanilla ETF without a hedge.
Okay, so can you suggest a broker?
No, but I really think, I mean, when you go online and you Google, you will find, I would recommend if you like online, and clearly everybody who is here likes to be online, then you already have a very cost efficient framework for investing. So these are online banks. You should look at the online banks, and you should look at specialized online brokers. And there are about 6 or 7 active in Austria, and just, go through them and look at the small print of the cost. This is tiresome, but it's worth it.
Okay. Ulrike, there's another question. Elisa also wanted to know if you could share the presentation somehow. Well,
you just have to tell me, didn't I send it to you guys before the event?
Well,
so you can share it.
Okay.
You're free to share it.
Okay, so we can do that, or we can organize that later. And Ulrike, so is an ETF saving plan, sorry, do I have to pay a transaction fee every month?
Yeah, in most of them, yeah. But in Austria, the answer is yes. And be careful, because we have what you should, because that's important. Because you also asked about a name of a broker. The one thing I would recommend is to work with a broker that is domiciled in Austria. Why? Because he will give you a tax reporting. So the tax will already be deducted from your portfolio. You don't have to do it yourself.
Good to know.
Yeah. So otherwise, you have to go to your tax advisor, or you have to go and fill in the tax forms yourself, which is a huge hassle. Yeah. And if you go to an international house, so I mean, they're nice, they're cool, but you have to do the tax returns yourself.
Mm.
Yeah.
Okay. Yeah, so we have 1 minute left, 1.5 minutes left. Marina wanted to know a bit earlier, what if I want to invest a bigger amount, let's say about 10,000 euro? Is it also better to invest in ETFs, even if I need it within 5 years? Well, we heard about that a bit.
Well, it really depends on your targets and on your risk appetite, right?
Yeah.
And your experience also. I mean, equities is something, risk is something that you have to become kind of familiar with, because it's easy to say, yeah, I can take it. If you have never lived through a loss, I wonder whether you can take it. Yeah, so always err on the cautious side. But I think with a portfolio that's 50-50, or as I said, 40-60 thereabouts, that is something that should be doable. I would recommend perhaps not investing everything in one go, because at the moment markets are very high.
20 seconds, sorry.
Spread it a bit. Pardon?
Sorry, 20 seconds left. I just don't wonder if it's...
Yeah. Yeah, so that is, and ETFs are very efficient, very cost efficient. As I said, when you invest in bonds, not always the best solution. So if you have a high allocation to bonds, and 50-60% is a high allocation to bonds, then you might also take actively managed funds into account.